Good morning to everybody, and particularly dear Vice President, dear Thomas. I'm looking for, yes, she's there, dear Vice Governor, dear Edeltraud. Ladies and gentlemen, cordially welcome to this meeting, this high-level meeting on investments and hard budget constraints. And welcome for those who have not been here, some of them to the renovated Kassensaal. Thomas just asked it, it's a very nice hall. I said, yes, it hasn't been like that before, but we did it, and I think we succeeded in doing it. Today, the EIB traditionally presents the investment survey to the EIB, to the Austrian National Banker, and it's a EU-wide strategy. And the survey gathers quantitative and qualitative information of firms' investment activity, and hence the survey is a very important base for the activities and assessment in the sectors and of the countries. And Debora, also welcome. Great to have you back to Vienna. You should think about having an apartment here. Would become perhaps cheaper, not really, I don't know what the prices are. Thanks, you will, to the presentation of the survey. Well, the presentation will be followed by a panel discussion on financing investments with fiscal policy. And as fiscal policy is contracting, and I think this will be something which is, will occupy us all over the next months or years there, albeit a change has taken place. This is not in my script there, but the change I see is that until recently, politicians were in bad mood because they had to find out that after so many years we could spend. They would have to cut back, get into a mode of reducing the deficit and the debt. And now what we have, defense. And suddenly it is, now we can spend again. So I think this is something, I don't know whether it will be part of your conversation, which will be quite hard to manage because it's really an expectation management will take place. And this leads me then to a few remarks on Austria. Austria also in a similar situation that we have spent too much in recent past. We have been very generous when COVID interventions took place. Now we're cutting it back, or we want to cut it back, or this has gone back, but now we have to take care of our budget. And we have followed, I'm sure, the most recent developments here in Austria for those who are from the outside. And we have a new government, and the new government looks to have a correct angle on it. And this will be their job over the next couple of years. But the problem will be, how to say, for the next couple of years will be to comply with the rules from Brussels to stay below 3%. Which will be quite difficult and a challenge. And thereafter, to even more so in order to carve money out for the things we would like to have, which is investments in these various areas. And I'm sure, how to say, the path towards that will be full of surprises there. But from what I can see, and that this will happen. The investment climate in Austria, how to say, has been muted as in the rest, much in the rest of Europe. And the reason is that, of course, as everywhere, the geopolitical risks have emerged, and the geopolitical risks are difficult to gauge and to say what it is, what will come out of it. And we have in front of us now the 2nd of April, where a person We tried all to figure out what he thinks. We'll make an announcement, and this will determine then what kind of challenge we're in front of. But also very importantly, the question is, what should be our answer? Should we retaliate, which is possible, or should we retaliate, but in a way which is very selective in order to hit those who are his friends as a way of doing with it. But whatever it is, we will have quite some upheaval, and Schumpeter's disruption will be both necessary but also very difficult to absorb. But on the other hand, what we may be confronted with is that finally we are able to use all the potential we have in these countries, and there are greater small enterprises, large enterprises, to say that they may be the ones that take on the task and use the challenges there in the production. This includes, for example, if and as we are teasing up, we have, I'm always astonished when I come about great enterprises dealing with drones, dealing with IA, and we have a huge chance in this area to use them. And last but not least, and I finish with my cursory remarks on monetary policy, because this is all on our mind. What will monetary policy bring? What should it bring there? And here, this is my thinking, not ECB's thinking, is that what we have seen most recently is that we had a fall, we had cuts which we did, and these cuts were, how to say, are done in order to support monetary policy to come to its, steady state level there. What this is, we don't really know, and we avoid typical, and I avoid the notion of terminal value. But monetary policy can only be charged if you have a value there, call it A star. And the discussion of A star is an eternal one. It also happens within the ECB. But what we have seen there most recently is that the estimates from A star have moved. After many years of fall, the estimates moved back from -2 to around 0 there, which of course is quite a change. And the question is, why did the change take place and what does it mean? Why it take place, we don't know yet, but one of the conjectures which Isabel Schnabels put on the table some 3 weeks ago in a talk, the paper is around, is to say, until recently we had a situation in which investors into the safe assets, treasury, they were willing to forego revenues, convenience, returns, because they wanted to have the safe assets. This has changed for perhaps geopolitical reasons, but most importantly is that we have now an excess demand for long-term saving. That's the reason why the long-term interest rates worldwide increased. Now, if they increase and the yield curve needs to be there, then also the short-term interest rate is going to increase. And so we may be there, and my conjecture is we're already there at neutral level. So what it means for the next couple of sessions, the question will be there, how do we pitch our interest rates developments in order to deal with the geopolitical uncertainty, with the change in our star, and with the inflation rate pressure which may emerge from what's happening on the side of tariffs and the reaction to that. With these considerations, I wish you all the best in this morning deliberation. I can hang around at the beginning, looking forward to the presentation. And I assume I hand over to you. Please come up. Thank you very much. Thank you.
Thank you so much, Governor, Vice Governor, ladies and gentlemen. It's a true pleasure to be here again to take part of the presentation of this year's economic report under the leadership of our chief economist, Debora. I think we have had a series of meetings here that is always very fruitful and interesting. And it seems like every time we live in very hard to predict times. Since I became Vice President of the European Investment Bank 5.5 years ago, we've gone through first COVID with, totally unpredictable consequences in the beginning. The Russian brutal invasion of Ukraine that affected Europe thoroughly, of course, but the whole world, with the energy crisis and food price crisis that came after that, high inflation period, and now with a new unpredictable situation with the new administration in Washington that is, if I may say, a little bit hard to interpret from time to time. It has spurred, of course, once again, all of these events, the discussion of European unity and European cooperation, and now maybe in an unprecedented scale. Also, the European Investment Bank is affected by that. We have sort of the challenge of the Draghi report showing very clearly that Europe has an investment need that is momentous and must be financed with more vibrant capital markets within the European Union. I think a highly influential report that will drive also the new Commission's agenda very strongly, and where the EIB has an important role to play. With this year 95 billion euro of lending and investing in the group of EIB, the bank as the mother company, and the European Investment Fund as our subsidiary. Of course, we can play an essential role, not the only role, but an essential role to drive European integration also on the financial markets. But we are also, of course, affected by this insight among European Union members that we need to strengthen our security and defense and do it very quickly. And prime ministers of most of the European Union member states have called for a more active role also from the European Investment Bank in this context. So just last week, we took a decision to expand our eligibilities as a bank to finance also defense and security in an influential way from the European Investment Bank. We have our limits, of course. We have investors. We are a big bond issuer, as you know, and we have investors worldwide that we follow very closely on how they think about this. So we will concentrate on expanding our defense and security in high-tech fields, innovative fields, in infrastructure, and we stay away from the concrete weapons and ammunition, but there's a large scope for us to become an influensive financer in the field of European defense and security going forward. But also as the European Climate Bank, where we have set the standards for investing in climate-oriented fields, this is something that we hold very dearly and will continue the course. One of the consequences of the Russian invasion was, of course, the energy crisis and the Commission initiative to repower EU, as they very elegantly put it. And we have, since they launched that, doubled our investment into the field of energy. Last year, we reached almost 30 billion euros in an annual investment in energy efficiency, renewable energy, and grids and interconnectors. And this, I think, will be crucial going forward, because I might say that that is probably one of the crucial points for security in Europe, is to have energy independence and the ability to produce our own energy to innovate in the field of clean tech and thereby also strengthening European competitiveness. So the EIB Investment Survey reveals that many European companies are of course affected by all this uncertainty around them, not least when it comes to the effects on the trade system that we've seen through the various events over the last 5 years. And now with the tariff threat coming in as an additional component. And many European companies are protecting their value chain. We also see that Europe's climate leadership is paying off through the energy transition that has come quite far in Europe in quite a short time, and also our prominent position in clean tech innovation. But we need to do more to unlock priority investments and take clear actions to better integrate the European markets, because we have a true asset in the European Union as a joint market, and we can do quantum leaps when it comes to the European capital markets that would benefit us a lot. A lot of things are being put in motion now. The European Commission's initiative on the Savings and Investment Union is hopefully an injection that will make us take those steps on the European capital markets and broaden the investor base. One might say on the fields of innovation that we have taken very large steps when it comes to seed financing, early financing of innovative companies. Where we have a lack and a void is the scaling up possibilities in Europe of our tech innovations. And we need to help the capital markets by cooperating together to see to that we have the resources available to invest in scale up of our tech companies. We have taken an initiative together with a number of member states in the European Tech Champion Initiative, a fund of funds initiative run by the European Investment Fund, where we invest in funds that can bring large ticket investment to tech companies that need to scale up and do it in Europe. We suffer a bit from the fact that many of these companies, when they want to take the next step, look at the US capital markets and are lured there to be able to take the next step in their development. So these type of initiatives, I think, will be very important also going forward. 2025 is a special year for EIB in Austria since we are celebrating 30 years of membership in the European Union. I'm Swedish. We joined together. It has been, I think, extremely important steps for our countries to become members of the European Union. And it has been, of course, also paying off in a large extent. Since the year 1995, we have invested around 350 projects in Austria, provided more than 30 billion euros, compared to the 600 million investment in own capital from Austria into the bank. It has been a very profitable investment, and we have a former vice president on the first row that can testify to that. Let me give you a couple of examples of what the EIB group is doing in Austria right now. We co-finance wind and solar projects together with partner banks. In Burgenland, it is providing up to 108 million euros to finance 6 solar power parks that will supply 71,000 households with electricity. And the farmland that they have been built on can be continued to use to grow crops. In 2024, Burgenland Energy AG received EIB financing of up to 350 million euros for 30 individual projects to build solar and wind parks, 1.3 gigawatt once they are complete. Quite a substantial contribution to energy supply in Austria. In the district of Carinthia, with the rollout of broadband services with very high capacity networks, connect 22,000 households in 40 municipalities in areas where the commercial market has not really been able to supply the investment needed. And this is a role that we always seek for, where there are investment gaps, where our investment can help to crowd in private investors to see to that we get investments in place that otherwise hardly would have been done. So ahead of us, we have a lot of interesting things to do together. We have a pipeline that looks very promising, and our head of the Austria office, Frank Schuster, is always ready to look for new interesting projects. And of course, in times of fiscal limitations that we see in almost all European countries, to try to find the way how we as a bank, together with private partners, can stimulate investments without directly hitting to constrained budgets is, of course, I think, a precious need going forward. Thank you very much for giving me the opportunity to say a few words. And now we go into the actual investment report. Thanks a lot.
Thank you very much, and it's a real pleasure and honor to be back in Vienna, a city which I love very much after being a resident in Vienna for a few years, a long time ago, and to have the opportunity to discuss our work in this context in a moment in which it's become so relevant, the topic we are discussing. So how to achieve more investment in Europe, how to deal with the many challenges that Europe has at the moment, and Austria shares, that is dealing with security and defense and dealing with competitiveness. Actually, we are publishing and distributing, I think, outside two reports. One is our overall take on investment in Europe, and it's the EIB Investment Report. And the second one is a survey specifically on, we have the European side, but the report here is specifically on Austrian firms. And what I will present now will be influenced by both of those. So I start from the big picture. I think there is no doubt that Europe's priorities today are really security and defense and competitiveness. It's coming out from the Draghi letter report, the competitive angles, and I think the security and defense has come as a prominent priority in the last months. The concern, if you want, is that we come from a longer period in which actually investment was at the center of the policy agreement at the European level, but actually investment activities is not so strong, and I will show it in a moment. So the question is, how can we engineer from now on a further acceleration of investment after so much has been done in the last years to keep investment going? And then the analysis that we have actually points to three elements. The first one is very similar to what the competitiveness compact is already saying. We need a business opportunity, and to have a business opportunity that are necessary for investment to come, we need more market integration, simplification, and innovation. And I think that's a very important element to look at. We also need to leverage on what is European strengths. And European strengths, we dig into two elements that are, one in particular is likely to become a bit more controversial globally, that is the green leadership of Europe. And we have a stronger point of saying that actually that's one of the assets that Europe has achieved, and is in our own interest as a continent to proceed in this direction. And the other assets we have to leverage on is on the track record of Europe on social investment. And I will show how social investment actually has economic benefit, is an important area to leverage on. And then, and I think very relevant to the title of the conference, a time of limited fiscal resources, what should the public sector do? There are a lot of initiatives that try to enlarge the headroom for action, but we think that it's very important in terms of measure to look at two things, two messages. Measures should be targeted and should be European-based. We think this is the key for policy intervention going forward. That's the main leitmotiv, and now I have, as usual, Economist, a lot of slides. I will try to go quickly through it, and you will find also the report outside. I start from the European picture. European picture, you see, investment was really part of the policy response post-pandemic and energy shock. At the European level, you see very strong investment happening. 2024 marks the correction. And actually what you see at the European level overall is still a very strong reliance of investment with the positive dynamic coming from public sector intervention. And actually the public sector has been strong both for direct public investment, but also for investment grants to the private sector. And we are still in a period in which this public support to investment is relatively high, and despite that, private investment is trending down at the European level. In Austria, I think we have a similar picture on this side, public investment up, investment grants up. We all know also in Austria, part of the public investment through ASFINAG gets out of these numbers. But on the left side, you see the dynamic in terms of investment activities remain in the last 2 years more negative on the Austrian side, very much also following the path on the German side in terms of investment activities. So the point is really we come from years of very strong policy support to investment, the public sector playing a strong role to try to incentivize investment, and still we see investment that is overall weak at the European level. And here comes something a bit more historical that we were trying to look at. When in Europe did we see period of sustained investment acceleration? And in fact, what we see is that period of sustained investment acceleration, in fact, happened in a few periods that were characterized by structural shift that generated business opportunity. So it's the business opportunity that calls the private investment, and it may come from substantial structural shift. We have a period of investment acceleration associated to the EU single market, to the large EU enlargement to the east, Euro adoption with all the pros and cons that we all well know. But the last one is also interesting because it's related to this full policy framework of the Green Deal and the Recovery and Resilience Facility, but also we think there is a lot related to the Green Deal and creating a new market for investment there. So going forward, what can we expect? I think we come from a lot of public support to investment. It will continue. We have evidence that there is the new stimulus coming from the security and defense and from German policies coming up. But we also think that it's very important. Oh, that's me. I apologize. But we also think it's very important to consider this creation business opportunity. That is what will drive the private sector, in fact, to invest. And here come the points. So we think that European integration and simplification have a lot to contribute still, and despite the whole process of integration that we have seen in the last years. In the report, we look at a few things. I start from what is, and that's also our survey, barrier to investment. That's maybe it's not integration, but is a simplification at the national and European level. We always ask in our survey to firms if they face a barrier to investment. You see that Austrian firms are more negative than European one. We always have the main barriers that are skill staff, uncertainty, energy cost that are main barriers. We also have business regulation, labor market regulation that seems to be more perceived at the Austrian level than at the European level. This is one part of the story, but we also were trying to look at a bit with a more theoretical exercise, looking at a sector, country level over time and looking at these barriers perceived by firms. If you manage to abolish a barrier, actually you have a substantial effects in terms of sectorial growth, 3 percentage points over a 4-year period. So actually these barriers that I was mentioning before are actually constraining business activities. We also have a way to calculate the cost of bureaucracy. We actually know through the survey how many people companies hire exclusively to deal with bureaucracy. So, and we calculated what's the level of their salaries over total turnover. We come to some 2% over turnover. It's a similar Austria and the EU. It's around 3% for SME. And if you think the cost of the energy bill is 4%, so it's not trivial. It's almost like it's half of the energy bill cost for industries. And that's just the cost of bureaucracy. We also have one question in which we ask firms if they export to another European country, so a European firm as exporting to another European country, if they face barriers related to differentiated consumer protection standard, VAT, etc. I was expecting 0. European firms and Austrian firms, 60% tell us they face a barrier. It really means that the single market has an upside potential of integration, just reducing these consumer protection, VAT barriers, non-technical barriers, if you want, that remain behind the market. We also were looking at the integration in terms of capital market. Here I just give a couple of messages on this. Why is it important to think at not capital market union, but at an investment and saving union? And here we think actually that there are 3 points that are very strongly interrelated, or 4 points if you want. The first one, we have an issue with households savings. A lot of savings in Europe, and here you have US, Austria. Austria is a bit more sophisticated than the rest of Europe, but it reflects more or less Europe. It's a lot of cash and deposits. What's the negative out of this, if you want? Nothing bad if people are prudent, but on the long term, they will not have that much return from their investment, and also on the saving point of view, you run into issues in terms of planning for the future with aging population. So we have an issue in terms of households behavior and too conservative behavior. And that's something where financial literacy and more opportunity for diversifying portfolios may help. We also have, and that's the second point, normally in the US, who is playing a big role in terms of intermediating savings to equity investment is also pension and insurance funds. Here in Europe, we have something very interesting. So there is a graph mixing that is the size of pension funds in Europe on total financial assets is small. Insurance is relatively big compared to the US. But then what are pension funds doing? So small assets overall, they mostly invest, when they invest in equity, they actually mostly invest in the rest of the world. Very little domestically, very little in the domestic market. There are exemptions, Nordic ones, I see Thomas here, but generally, actually, it's a very little investment in equity, small assets, little investment in equity, and mostly international. Then insurance corporates is very interesting because when they invest in equity, there is a lot of domestic bias. It shouldn't be there by regulation, but is there. And there is because there are many kind of infringement in many countries that somehow incentivize the domestic investment in equity. So also on the institutional point of view, capital market union or investment and saving union, there is something to do on the households. There is something to do also on regulation for pension and insurance funds to really play the role of investing more in equity, not only, but also investing more cross-border in equity at the European level. And then we have what does it mean for firms? For firms, it means that at the end, equity finance is much less available. And actually, and that's our analysis shows, we look at all firms in Europe that access equity finance to finance investment. And then what we see is actually that when firms access equity to finance investment, they actually have a much stronger investment rate, are much more likely to seek production capacity expansion and are much more likely to innovate. That's coming from our survey, but it really, econometrically, if you look at the identical firms before and after, having access to equity has this effect. And then we were looking at if the structure of the capital market in which they operate has an influence, and there are two interesting elements. The first one is capital market debt is really relevant. It's increased a lot the probability of a firm of issuing equity. The second one is also interesting because we built an indicator where we have either large capital market count as large, so they have the size effect, or the smaller one can compensate with integration, capacity to access international funding from abroad. And that's also relevant. So it tells you that for smaller countries, also having integrated capital market can be a support factor. And then something very close to also what is our interest at the EIB level, we really see something happening, as Thomas was saying before, in terms of innovation finance, particularly when firms are scaling up. We actually were looking at firms in the EU and San Francisco over time in their growth phase. And we see those are the scale-up group of firms. We monitor all of them over time and look at the access to finance they have. And in fact, what you see that 10 years after, the EU firms have 50% less financing. That means two things. They grow much more slowly because they have less finance, and also they get less finance. We really think there is something to do in terms of supporting this part of the market to develop, and we are looking very much on different products, both in the indirect and maybe direct side of financing in order to compensate this gap. I know that on Austrian side, and that's I was putting some number actually, in terms of VC-based companies per million of people, actually Austria fares relatively nicely. And in terms also in terms of VC investment as a share of GDP. This number, of course, are very tricky. EU GDP is very big, but I think the fact that there is some vibrant culture of VC companies in Austria is there, and it's something very important for you to take care of. Then I come to the last 2 points, the 3 points actually. One is leveraging on EU green leadership. So I was saying we need to care about European competitiveness. We have something to leverage on. And on the green leadership, actually, I have so there is a lot coming up. We know that the net zero transition is not easy, and there is a strong cost for the economy to adapt. On the other side, we also know that Europe is a net energy importer, and as a net energy importer, actually the transformation of the energy sector with energy efficiency, with renewable, is actually something that will bring stability to the EU. So that's on the positive side on the long term. But there is a side effect, if you want, of the very strong net zero ambition that the EU had in the past that is interesting to look at. The first graph is the collaboration network in terms of patenting at the global level. We all know that Europe is kind of lagging behind in many areas in terms of patents, is relatively okay on green patents. China is picking up. But what this graph tells us is that when people want to cooperate in terms of patenting activities, there Europe is at the center. It's the only activities in which it happens. So actually there is a value of the ambition that we had that has brought to innovation and that has made Europe a center for collaboration in terms of innovation patents. And that's really the only area in which Europe is at the center network. And I think it's something quite important. The other element, we went very granular in terms of export of a green good product. So we went granular on all single elements, and we were trying to look at who is gaining from this growing market, export market of green goods. For sure, China, very much 79% growing export. Europe is facing quite well, and I think also Austria is 40% growth in export in the period. So actually, it's an opportunity for European business, the green market that is developing. I'm very long, so I skip a couple of things, but actually I go to this one. This is coming from our survey. Actually, in Austria, when we ask firms if they think that the net zero transition is a risk or an opportunity, you have slightly more firms seeing an opportunity. And actually, firms are starting to move into investing in mitigation and are slightly more active in the Austrian way compared to the European overall. If we look at adaptation, if you want, physical risk and adaptation, Austrian firms have more or less the same perception, slightly higher of the risk than European one, but they are actually slightly more active in terms of adopting a strategy to deal with the physical risk or investment solution to reduce exposure. So it seems that on both on the mitigation and adaptation side, companies are looking at the opportunities coming up and the need, particularly on adaptation side. On social investment, I was again saying that's an enabler, and I think what I wanted to mention is mostly on this graph. What we were trying, so the idea is that actually at the times of a very strong aging population, very strong lack of skills, and a very strong social dynamics happening at the European level, we think that it's an opportunity to look at the effect of social investment, not only on the social side, but also on the economic side. We tried some simple example, and that's on the European side. So we say if we match at the European level in every country to go at the best in class of European countries in terms of lowest level of women currently not in work. Or if we go to the best in class of Europe of men and women with low educated father currently not in work. So it's all ways to attract people to the workforce. And actually what you see is the overall effect in terms of GDP growth at the European level. So there is, it's a long shot, this example, but it's saying that actually if you have specific social investment measures that think at labor force participation and better outcome for people, you may have economic effect. And the other graph is just showing that Austria may gain more or less as much as other European, the average of the EU from all these areas. The last point that we are looking at, and it's a very strong policy priority recently, I think it's really emerged in terms of housing affordability. And the reason is that housing affordability is mostly affecting younger generation and mostly affecting working in cities that also affect the way in which the labor force move to catch business opportunities and effectiveness in terms of labor force mobility. So that's something that is emerging as a top priority at the European side, national side, European side, and also from the EIB point of view. This is just to say that there are a lot of policy priorities, security and defense, competitiveness, but social investment, the social part is also part of the competitiveness element if you need to, and we need to keep an eye. I come to the last point. With all these priorities, the capacity of the public sector is not infinitive. We know that there are discussions in terms of how to expand the capacity for public sector intervention at the European level, particularly on the defense and security side, with SAFE program and the national exemption clause for public investment now currently being discussed. We also know that the German new approach is actually for much more public sector intervention than in the past, in terms particularly on infrastructure and other priorities. We think that generally there are two lessons that are important to be discussed. One, actually, and we have a strong experience at the EIB, at the European level, with financial instruments. Financial instruments are a way for leveraging resources and obtain through catalyzing private investment much more than the original source of money. We think this is something quite useful to look at in many countries as a way for having the private sector participating more in the big investment needs that we have. The second point, and that's what I was mentioning at the very beginning, we actually were looking through our survey at how many firms are receiving policy support, be it national or European level, and what the effect of the policy support is on firms' investment in certain policy outcome. What we see is actually something quite interesting. Firms are much more reactive to targeted policy intervention. So be it intervention directed to energy efficiency investment. Targeted means the money comes with a label attached and the firms have to deliver on that. And what we see is actually that the targeted element is very important for the effective response of firms. Actually, if money are not targeted, often firms don't invest at all. So we think that there is a strong point. If you have to intervene with policy support to the private sector, better be targeted to the policy objective that you have in mind. The second point is also interesting because every time the private sector intervenes supporting companies, actually there is a distortion of the market. And what we calculate is actually the distortion of the market generated if the measure comes at the national level or at the European level. And actually what we see here is that there is a strong rationale for having a EU intervention rather than national, because actually the distortion element is reduced. And this is particularly true in mid-tech sectors, because probably, that's our explanation, in high-tech sector, everybody, EU and national, tends to do the same thing, supporting the most productive, innovative companies. In mid-tech sectors, there are more mistakes or deviation, if you want, in terms of productivity and market integration, where measures are nationally implemented. So the final message for us is really, when policy support goes to the private sector, keep in mind two words, targeted and European. With that, I close. I think we are in a moment in which investment is needed. The key to unlocking investment is really business opportunity, and market integration, simplification, focus on innovation finance are very important elements. We think Europe has something to leverage on, the green leadership, social investment, and when public measures are used to support private sector investment, we come to the point targeted and European policy are very important, also because particularly the European policy, also because they defend the single market that we have behind. So thank you very much.
Thank you very much, Debora. Hello, ladies and gentlemen, and welcome to our panel's discussion. Today we are going to talk about investments under hard budget constraints. Before we start, let me briefly introduce the honorable panel. As our host today, Mrs. Edeltraud Stiftinger, she's Vice Governor at the Austrian Nationalbank. Hello.
Hello.
Next to me, Matteo Ferrazzi, Senior Economist at the European Central Bank.
Investment Bank? European
Investment Bank, I'm sorry. Mr. Oliver Picek, economist at the think tank Momentum Institute. Hello. Peter Pat, director at the Ministry of Finance. And Mr. Peter Kollmann, Chief Financial Officer of our energy supplier, Verbund. Welcome. Hello.
Morning.
My name is Marina Delcheva. I am head of the economic department of the Austrian weekly magazine Profil, and I'm really looking forward to a very vivid, interesting discussion, after which we will invite you, dear listeners, to join us with your questions. Unfortunately, as you already mentioned in your starting remarks, it is safe to say we are not living in a better world today as a year ago. The war in Russia's war in Ukraine is still going on. US President Donald Trump has set globalization on fire with his quite erratic tariffs policy, and he has turned the US more or less against Europe. The OECD has recently lowered its world GDP forecast for this year, and on Thursday, our two biggest economic institutes are expected to do more or less the same for Austria's GDP forecast for this year. We have no more money left, but we need investments to kickstart our economy. And to rearm Europe for a new world full of geopolitical uncertainties and even enemies around. I really didn't mean to sound too dramatic, but do you, or at least one of you, see any light of this tunnel of economic obstacles we are in for quite a time now, or how do we get out of this misery? I would like to ask you for your initial statements. Ms. Stiftinger,
well, thank you. Thank you first. Before I come to your question, I would like to start by thanking all the panelists and the speakers of today for their presentation and their contribution. Thanks a lot. Well, coming back to your question, as it is stated already several times, and it is somehow a common knowledge that we are operating in a very complex and a very, very uncertain geopolitical and economic environment. And as we all are well aware, there are trade uncertainties, there are wars, pandemics, and the ongoing challenges of the climate change, just to name a few of the current challenges we have to face right now. And these factors, in my understanding, have a significant impact on inflation, on market volatility, and overall on economic stability. And in addition, established certainties about the international cooperation and the international order have been shaken too. And some alliances have strained, but others have converged. And we have seen political decisions that would have been unthinkable just a few months ago. And therefore, the uncertainty is extraordinary and exceptionally high. And in consequence of all these circumstances, this also has an effect on the investment decisions of companies, and they are even becoming more difficult. Coming back to our own business, we have to say that there are also rising fundamental questions for monetary policy. Our governor has already stated it. How can we ensure price stability in a new geopolitical area is simply the question. And this will be a huge task. Christine Lagarde addressed this challenge in a speech just a few days ago. She said that it requires first an absolute commitment to the inflation target. It requires second the ability to recognize what types of shocks require a monetary policy response. And third, she addressed the need of flexibility to react appropriately. So central bankers need to be flexible to adapt their stance and their tools to new circumstances. And nevertheless, I'm really confident that the reaction of the European Central Union to the recent inflation episode has built trust. And has shown that everything necessary will be done to always ensure price stability. And after all, ensuring price stability in the medium term is what central banks can do to reduce uncertainty. And that's what it's all about right now.
Thank you very much. Mr. Picek, do you agree? Do you have a totally different perspective on the challenges we are facing and how to deal with them?
Well, I mean, I think the challenges are profound. It's a bit of, the question is a bit of how to do everything at once. We want more investment in defense. We want more, but we also want more investment. If you look at Austria, right, like actually you want more investment in childcare. We want more investment in our electricity grids. The question for me from a fiscal policy point of view is how to do that. And certainly for the first few years, we can use debt for that. We can have more debt, except the fiscal rules in Europe prevent that. So I think it would be a good idea to actually not only not only make exceptions for defense in investment in those fiscal rules, but also broaden the exceptions to other areas where we need them, right? I mean, for example, electricity grids or something like that would be a good exception, anything related to infrastructure. Social spending and recurring spending, for example, let's say the salaries of teachers, right? Those should be covered by state revenue, right? That's not something that should be financed by debt. And for that, I think we have to come to a social agreement that people that have a lot can contribute more, right? Because we're saying, well, everybody has to contribute now. We need the revenue. But I'm wondering, you know, if I look at the package that we've made in Austria now, why is there not an increase in the corporate taxes? We've seen this in our neighboring countries. We see this in Slovakia, in Czechia, in Slovenia. They've all raised corporate taxes. Why haven't we done this in Austria in order to get more revenue to finance all these important things? Also, why don't we see more wealth-related taxes? Right? There's a lot of the long-term view on how to finance these things is certainly a savings package for expenditure that we're doing anyways, right? The savings package in Austria now is basically all revenue, all expenditure cutting. It's some small portion is increased expenditure. But if you want more expenditure, if you want more investment, then you also need to have more revenue, and we're falling short on that.
We are going to focus on the wealth tax issue a little bit later. Meanwhile, I would like to ask you for your initial statement, Mr. Ferrazzi.
Right, thank you so much. So we have seen a lot of changes I would say, in the last years, and in the last weeks, we see an acceleration of these changes. So that's really sometimes complex. What I mean could sound a little bit trivial, but for EU institutions and the European Investment Bank, we are not in the business as usual mode, not at all. You see from the news that there are a number of actions. To be sincere, we've seen this deterioration of the geopolitical context since some years, especially after the Russian aggression to Ukraine. And so there is already some preparation on many different aspects. And now in the last weeks, we see a lot of focus on defense that became one of the priority of EU Commission and also the European Investment Bank. But it's not only about defense. So it's a broader concept, I would say, starting from the competitiveness. We have seen the Draghi report was mentioning like a radical change is needed. So there is a big push to be competitive, and all is security, because we are talking about energy security, critical raw material, defense and security in the strict sensus, but it's the sort of European competitiveness that is playing a role. And defense, of course, now is very, very important. And what also was mentioned before, we should not forget that there are not only problems, but a lot of business opportunities. We have seen the investments growing very much in the periods of changes. So if we want to see the positive side is there. And the other positive side is the EU leadership in green, in the social system. So this is really something US citizens are looking at us. And I would add also the single market. So a huge market in which companies and people can travel and work a lot. Well, I think most of us, we are examples because our companies are working abroad. I've been working many years here in Austria, studying in Spain. And the labor mobility now increased a lot, and also the opportunities. So I think these are the EU strengths that everybody of us can leverage on, companies and citizens.
Thank you very much, Mr. Kollmann. Verbund is our biggest energy supplier, electricity supplier at least. What are the obstacles from your point of view, and how do you see, what impulses would you set to get out quicker of that economic?
Yeah. Before I go into the specifics on the complex world of energy, maybe a few general statements. Arthur Schopenhauer said, a pessimist is an optimist who's got all the facts. So I'll try to be, I don't have all the facts, I'll try to be a realist. I would just like to sort of like add on to some of the comments here. I think what we see in Europe today is an abundance of regulation that has been mentioned before. But what is even more striking is we see an abundance of objectives, of goals, of targets, and we see a scarcity of achievement, success, and implementation. This is very often called sort of like a policy overload or an implementation gap. And that is something we need to focus on. And I think we need to take this extremely seriously, because what we're going to have over the next few years is a real trilemma. A trilemma in the sense of we have huge investments to make, and I'm sure we'll talk about those. At the same time, as you have mentioned, we don't have a lot of leeway because we're already at a very high level of debt, not only in Austria, but across Europe, with a few exceptions. And at the same time, we have no growth, or very little growth. That is a true trilemma, and it's extremely difficult to get out of this, and that is something we need to discuss very realistically. On the energy side, maybe I will comment on a little bit later.
Yes, please do so. I will ask you. Mr. Part, you have a very unpleasant role in this trilemma to actually consolidate, you and your colleagues. So what is your starting point?
It's rather tricky, because we're really in a rather difficult situation, because we come from post-crisis, from the post-crisis area with multi-crisis. We had COVID, energy, inflation, geopolitical crisis, and this is underlined by structural challenges such as population aging, which sometimes is forgotten, but we are amidst in this dynamism where population is growing rather rapidly, And this has an impact on public finance as well. We see that, of course, also in our forecast. And there's also impact on labor supply, on labor skills, on all that issue. So from that point, it's really challenging for a finance minister now to deal with all this. And also given the uncertainty we are facing around the world, we don't know what tomorrow will bring about the new policy decisions and customs see or not, and so on. So there's no stability in the policy decision, and I think we're really facing a really challenging world here. And therefore, I'm quite happy that we have now this government program, and also with the measures and saying now we are going for this kind of consolidation, also with active measures in order to stimulate growth, in order to anchor a little bit this uncertainty, to give some perspective, which would also then help a little bit in anchoring expectations also in Austria and providing then a kind of stability. But nevertheless, it's really challenging, and we know every day there could be new decisions necessary, and we have to be prepared for.
Thank you very much. Before we focus on the specific fiscal challenges we are facing in Austria, particularly in Austria, let's first talk a little bit about the European perspective. Mr. Ferrazzi, how can we preserve public investment in times of tight budgets all over Europe, not only Austria, but a lot of other countries like France, Belgium are struggling with their deficits? And probably more specific, as a representative of the European Investment Bank, where do you see the EIB's role in the new rearm Europe? You've had a significant contribution in the green transition. So what will be your contribution in the rearming transition of Europe? It is a transition, actually.
Okay, so I will maybe start from the public investment side. So just a bit of background. We started, we said, from the COVID crisis and the energy crisis, in which the governments were put money on this to support companies and citizens. We have seen the public debt over GDP increasing. For Austria was around 12%. This was in line with other countries, in line with Italy, for instance, a bit more than Germany, but less than Spain and France. So it's a bit intermediate level. So, but there's a big jump in the public debt, and now there is the correction. There is the reintegration after 5 years of the fiscal framework. So the fiscal rules will be relevant. And many states, this is not the case for Austria, but many states were counting a lot on the recovery resilient facility. And this is going to expire in 2026. So we will see many countries with this challenge. So this is the background. Now there is a new design of the Stability and Growth Pact. So this 3% and 60% are still vetted, but with a long-term perspective. And there is an incentive to keep public investments. So the discussion with the Commission will be on the possibility to enlarge the period from 4 to 7 years and to preserve public investments. So the fiscal framework is a bit more growth-friendly now. And what we see from the plans of the countries that already presented the plans to the Commission since September, that this time is different. It will not happen like the global financial crisis, in which all the countries were shrinking their fiscal side and sacrificing public investments. This was common in all the European countries at that time. Now we see that for the majority of the countries, the public investments are preserved. In terms of numbers, we have seen in the slide, maybe in different slides, that public investments is around 3.5% of GDP in Europe. So it's not a huge amount if we compare with the entire fiscal space that is 45% of GDP. So that amount is quite relevant. On the background, there is another good news, that is the German fiscal package that is influencing very much Central Eastern European countries, Austria, Italy, but also in general Europe. That's very relevant. So I see some good news in this sense because there is space for preserving the public investment. So rearm, if you want, we will touch base later because it's a bit complex topic. For Austria is more gradual. Austria is not NATO member. But the military defense expenditure in Austria is rather low, like in many other European countries, below 1%. And the target of 2%, that was the previous NATO target, is far away and will be reached in some years. The role of OEB, we said also security and defense is becoming one of the priority of the bank. And last year, these investments were doubling in the size, and we expect this year also to double. Again, so there is room to do, and the bank is ready. But if you want, we will enter a bit more the details. Some big decisions were taken last Friday with the increase of the eligibilities, so the possibility of financing non-lethal equipment. So we are talking about movement of troops, barracks, artificial intelligence, drones, cybersecurity. There is a wide spectrum of security activities, non-lethal security activities that the bank can finance, and especially the support will be also for SME.
Which is actually a turnover in your policy.
Let's say it is enlarging what it was already before.
Thank you very much.
Well, can we stay a little bit longer at the European level?
Yes,
if it's possible, because because some of you might know that before my current position at the Austrian Nationalbank, I was CEO of the Austrian Promotional Bank for the Austrian economy to support growth efforts of the Austrian companies, especially, and also the innovation efforts. And what we did is that we have a common survey with the Chamber of Commerce on an annual basis, where we ask companies, especially innovative companies, what are the reluctances to invest. And there's always the same answers, and it's the sentiment is poor. When there is lack of qualified labor, of course, and of course, if financing is difficult. And that's what I want to focus on right now, because I think that's really an topic which has to be addressed at the European level, this financing topic, because we especially supported, or the Austria Wirtschaftsservice supported companies with guarantees and soft loans. So these are financial means which should be at least very attractive this time, because they are very budget friendly, to put it that way. And what we see in the last survey was that, and about 2,500 companies take part, and two things became really even more apparent last year than the years before. And the first was around 30% of Austrian companies made large or medium-sized investments. Only 30% of the innovative companies, which is really the low since the annual survey began, and it started in 2009. And second, and that's the relevant thing out of my perspective, corporate financing has deteriorated further from the company perspective. So in many cases, companies had to postpone investments because their loan request was rejected. And as you and about 31% of the companies stated that this was the main reason that they were not able to invest. And we all know, and I know that you are a great partner here, the European state aid law provides us with a maximum limit of 80% of public risk. That sounds very high at the first sight, but however, we see that 20% risk taking for banks still is too high. And I think that really has to be discussed. And of course, that's not an easy task, because it cannot be that or the solution cannot be that the state should bear the whole risk. But we have to deal with these consequences, because these instruments are not as effective as they could be. And I really want to address it at an European level.
Mr. Picek, you wanted to add something?
Yeah, I wanted to add two facts on the podium that I think could be interpreted differently as well. Mr. Kollmann said that we have too much debt, and if you look at the international perspective, I don't think that's true. Japan has much higher debt. The United States has much higher debt. So you could also argue that there's still some leeway for the European Union to go higher. Why not, right? Other countries are surviving quite well with it. And the second statement that you said is that the fiscal pact is growth friendlier now. And I agree with that's true compared to what it was before. But the growth friendliness of the fiscal pact at the moment is not there, right? It's still, if you had to judge it, you would say it's growth unfriendly, because what it's forcing us to do right now, in the case of Austria, but also of other countries, we are in a recession. In Austria, we have the third, upcoming this year, the third year of recession. And it's forcing us to do a large government cutting package, right? Which will weaken the economy further. In fact, the economic institutes had said, well, we're going to have a small growth this year. But also because of the savings package that we're forced to do now, that growth is going to be eradicated, and we're going to be most probably going to be negative in the forecast for this year, right? That's why I think we actually need, and that's why I'm so happy that Germany suddenly has come to its senses in terms of macroeconomic policy, even if the only reason they did that was because they wanted to produce more weapons. I mean, I would say let's produce more infrastructure, let's produce better social services. That's also a type of security. But okay, let's do more weapons. That's what they're doing. And that is actually what could save the business cycle for us, for Austria, for Germany, and for the European Union as a whole, right? That could provide the upswing. And the second task, I think, to get an upswing in Europe is for the central banks to be a bit more aggressive, for the central bank to be a bit more aggressive and lower the interest rates. Because the graphs that we've seen from Ms. Revoltella first, right? Exactly when the central bank started to increase their interest rates, then we saw a complete collapse of household investment. Of course, they can't afford their apartments anymore, they can't buy new ones, they can't build anymore. And we saw, with a little bit of a delay, we saw a corporate investment collapse, right? Which is also due to high energy costs, granted, but it's also a question of demand, right? So we need to turn this around, and only then will we have an upswing where we have good macroeconomic conditions, where then saving packages can be successful. Because well, if you look at the study that the International Monetary Fund made, if you want to have successful public finances, if you want a savings package to be successful, then you need good times. You can't do it in bad times. In bad times, 75% of the savings packages worldwide fail. They end up with the same or a higher government debt level.
Thank you. Let's stick a little bit to the central banks. You have a very powerful tool not only to fight inflation and maintain price stability, but also to provide economic stimuluses by raising or cutting interest rates, which you have been doing quite recently in both ways the last years. So where do you see the role of the central banks in setting new impulses for the economy in all those rearm plans of the states? And you also mentioned that you should also question the mechanisms you have right now. So what is your point on that, Ms. Stiftinger?
Well, first, first of all, and again, the ECB's primary objective is price stability. And this cannot be emphasized often enough. Stable prices are important for people and for the whole economy because then they feel secure in making plans to invest for the future. And this sounds also like common knowledge, but it's important and necessary to emphasize this again and again. Price stability is essential for the economy and job creation, and therefore it's my conviction that is the best contribution of central banks that can be delivered to guarantee security. And that's what's all about. But of course, monetary policy can influence growth impulses in three ways. Directly, first, because conventional monetary policy impacts investment refinancing costs, of course, and indirectly, because conventionally monetary policy influences the refinancing costs of existing public debt. And we all, most probably you already have heard the quantitative easing measures. They were used to fight the global financial crisis by increasing the demand of government bonds. And this has lowered borrowing costs for the public sector. But there will also be a reverse channel, because public investments can also influence monetary policy. If investments increase potential output, for example, if you invest in education, for example, that could lower the pressure of the inflation.
Thank you very much, Mr. Pat. Last year, we had a budget deficit of approximately 3.9% of the GDP. It is expected to rise slightly above 4% this year. We have to consolidate our budget. Only this year, you have to save 8 billion euro in spendings. Overall, it's around 24.
2 years' time.
In 2 years' time, I'm sorry. At the same time, we've heard it, we need a lot of public investments to kickstart the economy, to rearm ourselves and to come to those 2% of the GDP, which are expected from Austria, also on a European level. And we have to finance ourselves we have to refinance the state at the financial markets while the European Central Bank no longer buys government bonds. So how will this affect the fiscal policy and the fiscal situation this year? And do you see any scope for any kinds of investments whatsoever? I expect we're not going to the same thing as the Germans with their 800 trillion euro rearm and infrastructure package.
So a lot of questions. I think we all are experts now on the EU fiscal rules, and we know we have to come down to 3%. But I think more importantly, sometimes you have also to look at on the capital market side. What is there? What are they demanding? And what are the challenges there too? And what we have clearly seen now from the announcement of the German fiscal package and also von der Leyen, what she said. Immediately we had a reaction of the capital markets, and there was an increase in public bond yields by 35 to 40 base points. That's quite significant. That was an historic rise, and you see that deficit and interest rates they're interlinked to some extent, and that has also effect on growth, because that's another than the benchmark interest rates for the whole economy. And I think we really have to consider this, to look at these mechanisms. These are there. The good news for Austria is that our order books are full. So the investors buy public bonds. That's not a problem. Our Austrian Federal Financing Agency is doing an excellent job. Markus Stix and his team, they are really doing great in many respects, and winning awards, best funding team, green investor reward, everything like that. So there's stability in there, but the challenges are really there. We see the ECB is not financing anymore public bonds directly, so this mechanism is not there. So the financing agents has looked for investors, so they has to broadening the investor base. Our agency has done it with the new green bond framework. We really got new investors. We have the Bundesschatz now, and so on. So to be innovative in that sense, in order to master this kind of challenges, we face at the moment also on the capital markets, because they do react also on fiscal issues, and we should not neglect that and say that's not there. And therefore, I think fiscal consolidation is necessary to give the right signals also to the capital markets, because they're expecting that. When we are discussing budget policy, for instance, with the rating agencies, so they're really saying that. That's important, because we have a high public debt by EU comparison. We have a high initial public deficit net lending, and also a low growth environment, so and other exposures, and therefore I think some credibility in the past, in the strategy, is necessary. So that's why I'm rather glad that we have now this government program in order to have this kind of credibility and stability in this area. Maybe one word on public investment. I think here in Austria we are not in such a bad position, because investment levels, public investment levels, have been rather stable, and we have seen it in the graph too. It's even went up a little bit. That's not due to the fact that we have any exceptions to some rules or something like that, but that's simply the fact that we have good medium to longer term sectoral investment strategies, where we have then stability in this kind of investment planning, and not so much while we're doing exemptions or something like that. Here we can, of course, we can discuss every design of this sectoral investment plan, but overall I think it gave us the right result, and we are doing better here than compared to Germany, for instance. Because then when you look then, and I think it's not gross public investment what you have to look at, but net public investment, then we are doing good here, and by international comparison.
You were silently agreeing just recently.
Yeah, I was silently agreeing. I wanted to make a few comments on what you originally asked me about, sort of like the energy sector and Verbund as well. I mean, everybody knows that we are going to be faced with an energy tax over the next 5 years of around 200 million per annum. Is that going to make a huge change to Austria, to the budget situation? Me personally, I don't think so. But let's just look at the whole picture. Verbund last year paid 1.5 billion euros to the Austrian government through dividends and tax payments. 1.5 billion. At the same time, we have just increased our investment plan for the next 3 years from 5.5 billion to 5.9 billion. So those are investments that mainly go into Austria, into renewable energy, into hydropower, into the grid. At the same time, we are going to try and keep our debt level where it currently is. As a company, we have one of the best ratings, and you have mentioned how important ratings are. We have one of the best ratings of any utility in Europe. As a result of that, we have a lot of firepower. And this firepower goes into, for example, the grid, where over the next 10 years, we need to invest between 9 and 10 billion euros. And those grid investments are infrastructure investments. And those infrastructure investments are very important because it is impossible to integrate new renewables into the system if you don't have the infrastructure. So what you basically need to do in order to have a successful energy transformation, you have to do it a little bit like, some of us might remember Apollo 11, when people say, unbelievable, they flew to the moon. How did they ever achieve that? It was basically the 3 C's. It was capital, it was competence, and it was coordination. And that is exactly what we need for not just for the Austrian, but for the global energy transformation. We need a lot of capital. And I've just mentioned a lot of that capital comes from us, but we have to earn it. Yes, we can go out and we can raise capital, but that increases our debt level and that decreases our resilience. So it basically makes us weaker in the future if something comes along which we don't see on the road, bumps on the road. And we've seen that in the past. So like a country, we have to work on our resilience, but we have to earn our investments which we're making into the infrastructure. And in order to make it work, what we need is we need a policy framework where we have very clear rules, where we have transparency, and where we have competence and coordination. And that is extremely important to get the energy transformation done. If we don't get it done, we will continue to be non-competitive. And the problem is, and we keep forgetting that all the measures which we're going to introduce in Europe now are going to take at least 5 years, but probably 10 years to have an effect. And at the same time, we need to be aware of the resilience of Europe, so competitiveness and resilience. And we were just talking about defense. I think we're spending something like 350 billion every year on defense. Now we're basically saying that we need more. We need another, 250, maybe 300 billion of defense spending. But again, it reminds me of sort of like my Apollo 11 analogy. Spending money is not enough. Spending money needs to have an effect. It's a little bit like if I take it down again to the level of a company, if I basically make announcements, what I'm going to do, my investor immediately wants to know, okay, you're spending so and so much money, what exactly does it mean and when? And that is what I meant before about the implementation gap. In a private company, and we are 51% owned by the Republic of Austria, but we're still a listed company, that implementation gap we cannot afford because investors would not buy our shares anymore. What I mean by that is that even as Europe and even as a government, we need to be more pragmatic and we need to look more into how are we going to transfer policy and words into action.
Do you see anybody having a specific plan on what you just mentioned?
No.
Okay.
No, I see. That's how I started, and I'm not a pessimist. I'm a realist. But we have just look at Austria. We have increased, and I hope my numbers are correct. Over the last 5 years, we've increased our debt from 280 billion to something like 400. I think we're slightly above 400 now, within the 5 years. Okay. Now, if I were a company and I increase my debt dramatically, everybody, even a young student, would say, okay, and what's the effect? Well, the effect in Austria was that we had GDP, we had minus 1.7%. So when you compare that, that is the lowest in Europe, the lowest in Europe. Germany was also very low. Denmark was, over that 5-year period, at 9%, but they did not increase the debt by as much. So you can ask about effectiveness, you can talk about efficiency, you can talk about the lack of structural change, you can talk about many things, but when you look at the facts, we are not good enough.
Thank you. I will slightly change the subject.
Sorry.
No, it's okay. I would like to come back on the topic of wealth taxes, Mr. Picek. You've demanded them quite frequently, also during the last years. The new government of the Conservatives, Social Democrats and Liberals have decided not to implement them and refrain from wealth taxes and inheritance taxes. Still, we have to consolidate. And do you think we can consolidate the budget mainly, not only, but we also have the taxes on windfall profits and on banks, but mainly on the expenditure side? What is your point of view? And I suppose you will have a lot of cons in doing that.
Well, I guess everything can be done. I mean, you can be like Trump and abolish the Ministry of Education. You can be like Millet and use this chainsaw and cut through everything, except you completely destroy state capacity then, right? So the ability to get things done is then gone, right? The state cannot do it anymore then. So obviously you need a more balanced approach. The expenditure package that we see now is mostly, the savings package that we see now is mostly expenditure based. So I think there could be a stronger revenue side. Yeah, Mr. Kollmann has said 200 million of Verbund is not going to, you know, or 200 million of the energy companies is not going to save the whole budget. That's why I think we should probably tax them a bit more. We should also tax other sectors more. Banks, banks are making record profits, also thanks to subsidies that they get from the central banks in the way that they conduct monetary policy at the moment. Right? This should be taxed away. Those are 3 billion for Austrian banks each year. Takes 90% of that away, right? You get a lot of revenue, right? And of course, wealth taxes. I mean, the potential. Of course, you can disagree about the potential. I think the Ministry of Finance, if I'm correct, believes that wealth tax could bring 2 billion. I think it could probably bring 5 billion. We have an inheritance tax that can bring 1 billion, right? If we had one, like most countries in the European Union. In Austria, we don't have one. And regarding wealth tax, of course, I think if Norway can have a wealth tax, if Switzerland can have a wealth tax, and they're still extremely rich countries, much richer than Austria, then we can probably have one too. And property taxes are extremely low in Austria. And who's got the property, right? I mean, rich people do. Like the upper half of the wealth distribution has property, right? I mean, that's pretty much a fact. Like the lower half are renters. And the upper half of the wealth distribution, they own their own houses or several other houses and apartments, right? So low property taxes are not only a revenue problem, a lack of revenue for the state, but they're also, I think, a problem of justice on how burden sharing is distributed in the society. Yeah, and I think if we had all of this, then at least a few billion per year could be additional revenue for the Austrian budget. And that, of course, would solve not everything, but it will solve a part of the long-term financing problem that we have.
Can I make a comment?
Yes, please.
I would have a lot of comments, but I'll just focus on one. The 200 million of the energy sector, and I can only talk about Verbund. Will probably sort of like be responsible for half of that. There are two things which I would like to share with you. First of all, that money which we're paying out under other circumstances, we would have invested, obviously. But you know, that 100 million, just talking for us, not for the energy sector, we would have leveraged with debt, and we would have made, you know, depending on the leverage, we would have invested between 500 and 600 million euros. Into Austria. When you look at the grid investments, we have looked into the value creation within Austria, which is around 70%. So there is equipment which we have to pay to the Germans, for example, to companies there, because we don't produce it in Austria, but around 70% is value creation within Austria. So that's one component. The other component is that what we need, in my view, is more transparency. I would like to know what is the government doing with our money? Sounds very simple. But when you look at a company like ourselves as a stock-listed company, our annual report is more than 400 pages. It increased by around 200 pages within a relatively small number of years as a result of regulation. So there is more and more regulation. So I know there were huge announcements, how we get more competitive, how we are going to decrease bureaucracy. Again, words, announcement, I would like to see it. I would like to see action, very specifically. What are we going to do? So let's see. Let's be optimistic and let's see what happens in terms of bureaucracy over the next 1 to 5 years. But when you look at a listed company like ourselves, everything is to the smallest number. There is total transparency. Total transparency. Every investor, every retail investor that looks at our company and spends enough time to look through the annual report and our capital market reports will see exactly how much we make, where do we invest it in every single detail. That kind of transparency we would need with the government, because if we had more transparency exactly what is being done with the money, I think then we would have a little bit more diligence in terms of the effect of the government. And what we know and what we see is that there's the famous Staatsquote. I mean, we have a comparison and we see how other countries, and I don't want to hit on Austria, yeah? I'm talking about the EU generally speaking, with exceptions, Denmark being one, but Switzerland being another one. That's part of Europe, not part of the EU. But there we need more, I would say more transparency in order to be more effective with the money, what we do with the money, and how much growth can we achieve. Because if we don't achieve it, we are unbelievably unfair to the next generations. And that is one thing that is not being mentioned enough, that all the mistakes which we do and all the money which we spend now is money that is not there for the future generations. And when we talk about the great social system which we have in Europe, which is really amazing, we have 5% of the world population, but we have 42% of social expenses in the world. That's an interesting relationship. I know it's a simple one, but it shows you something. But in order to be able to achieve that kind of social welfare, not just for us, but for the next generations, is one of our big tasks, and that is something we should take very seriously.
Mr. Plath, you wanted
maybe one word on transparency and such. I think it's even better to have more transparency. But I wouldn't say that you don't find the information of where the money goes. We have the Court of Auditors is preparing now the budgetary statement on 2024, and this is about 16,000 pages. So there's a lot of information there. You have budget GVAT where you can find all the information there, and I think that's not the issue. The issues, and I think. That's the right argument. And what is the impact of this kind of measures, and what are we doing, and how can we screen this, and how to go for the right analysis? I think we have to put more emphasis on economic and analysis, what's going on, and then driving to the right solutions. I think that's the point. It's not so much that the information is not there. I think we have a lot of information on the budget. Particularly on the federal budget.
Thank you. In order to stay on schedule, I would like to ask all of you a final question and to close the panel discussion and open it for the audience. I would like all of you probably to close the discussion with a small to-do list for this year, 1 or 2 measurements or things, in your opinion, that should be done. let's start again with the lady.
Thank you very much. I can make it quite short and clear because the government, as we already stated a lot of times, doesn't really have an easy task, and we are all aware of that. And honestly, what nobody needs right now is some good advice from the sidelines. I would be happy if we really get involved in discussions with the government, and we are. But I won't do it with or through public channels, honestly. So, and from a national. From the point of view of the Austrian Nationalbank, it's really important, as I already stated a lot of times today, that we ensure our commitment on price stability. That's what we have to fulfill, and that's what we will fulfill.
Mr. Picek, your final.
I can actually subscribe to the idea of getting things done. I think that's a good idea, and also to what does your expenditure like? What does it do? What's the impact? I think I've talked a lot about the revenue side, but talking about government expenditure, I think it could be more impactful, much more actually. Because what we've done and what we've seen in the last years during COVID and also during the inflation crisis was that a lot of expenditure went out as subsidies that increased or improved the balance sheets, the profits of corporations or the balance sheets of households, even of firms and households that didn't need the money, right? So I think we should have, we need actually a redirection of government spending into the areas where we can actually have an impact, and where we need to have an impact, and I think where the population expects government to improve their life. What I mean, right? Like I would like to see, actually the thing that I missed most or one of the things that I missed in the new government was I would like to see a ministry of what was it called? Ministry of Building, right? I would like to see a ministry that is tasked with bringing rents down, building more houses, getting more affordable rental apartments, right? That's something that I would see. We used to do that in the past. It was not a problem for the government to build cheap apartments, but now suddenly we can't do it anymore. I mean, that's really, I mean, that's where I really subscribes to your get things done. I mean, this is what in the US they call now the abundance agenda, where they want they want a government that is capable. They want a government that gets things done, right? And I also think we need to get energy prices down, right? We need a reform of the merit order system. We need cheap energy prices, because as much as I'm happy that Verbund is making so much money, but the profit that Verbund makes is the loss of the industrial company, right? More or less directly, right? So that's why I would like to see. And I also think we need. What we can't just do, and I think it's going a bit in that direction with the combination of increased defense spending and lower social spending, because we need more for defense. If we do that, right, we will have a political problem. I mean, Russian-friendly parties in Europe are extremely strong. I mean, you could argue that in Austria the strongest party is very Russian-friendly. And if we don't want them to take over the government, then we need to do social spending and military spending at the same time.
Thank you. I'm afraid 9 regional governors and thousands of mayors would strongly disagree on a ministry of building houses. Mr. Ferrazzi, let's put the discussion probably more European level. What has to be done in your point of view from a European perspective? We're still in a union of 27 countries.
Okay, what is hitting the news now is the security aspect, but I think the focus maybe for the next years is to reduce the fragmentation that we have in the EU. And this is true in many different fields. So it's touching the security area, because we were spending in the past the money in a very fragmented way, and we are not able to defend ourselves, even if the total expense was high. There is room for, we have seen the possibility with the capital market union, the possibility there is a huge home bias in the investments, and we are not financing the ideas of scale-up companies. And we see fragmentation everywhere from any sector, probably in energy or in telecom, where in China and the US there are 3-4 operators. In Europe there are dozens. And I think removing the fragmentation sometimes costs a little bit also mentally for us because we have different nationalities. But this is the trick, I think, to leverage on the single market and what we have been built in the last years. And this is true for also citizens and companies, so to operate in a broader market.
Mm-hmm. Thank you.
Yeah, I would like to agree with Oliver on the energy cost.
This is surprising, but
No. I'm unbiased. And energy costs are 4 times, by some measures 3 times as high as in China or in Asia, and 3 times as high as in the US. Energy cost has a direct impact on competitiveness. So as a result of that, obviously, that is a very fair and important statement. The way to bring down energy cost is, I don't want to go into the merit order, but obviously you're right, it is the merit order. The merit order is mainly, or the price, the highest price in the merit order is influenced by 3 factors. Number 1 is the gas price. So when the gas price normalizes and when the gas price comes down, power prices will come down. The gas price only went up because of the war. And that war only happened because Russia had no respect for Europe, but that's a different story. The second point is CO2 prices. CO2 prices are political prices because demand and supply can be influenced by political decision making. And one could argue in the energy sector, do we really need a CO2 price of 70? It used to be 40, 30, 20. Where's the right level? That has a direct impact on the power price. And then, of course, it is how much renewables do we have within the system? The more renewables we have, the more the power price comes down. That is a very simplistic explanation, but that shows that should we have peace, within the next few years, hopefully within the next few months, then the gas price will normalize, power prices will come down. I think that would be very important for competitiveness, but I know it's too short for today, but that is only one component. In terms of competitiveness, there are many, many others. There is education, there is productivity, there is capital markets, and many, many other areas. So I think that as proud Europeans, we have unbelievable work ahead of us. And that is something where we really need to, and you're right, we should stop being sort of like, the doctors sitting around the patient and talking around the diagnosis instead of curing the patient. That is what we need to do. We all need to cure the patient. It is a patient and he needs to be cured. We need to do that. And that is a tremendous task, but we should not be shy to just grab it.
Thank you very much. Mr. Part, what is on your to-do list?
I think my personal priority is rather clear. I have to do the 2 years budget now until until the 13th of May. Then there's the budgetary speech, and we have to do all the preparation. That's quite busy time now, but that's only my personal. Otherwise, I would also echo Matteo and Peter on the European dimension here. We have to get the things done here. Labor forces, we need a skilled labor force, even much more skilled. We see the PISA results has gone down, and I think really we have to do here something. We have the productivity trap. I would also say that capital markets. I like what you have said on the simplification of markets. I think that's a really good word. I have to recall then in my presentation, future presentations, because that's really important to get deregulation, the fewer regulations. I think that's really important in Europe and for Austria as well. I think that's that's what we have to do now, and let's get the things done, I would say.
Thank you very much. Thank you for talking with us and to one another. Thank you for listening. I would like to give you now the opportunity to ask your questions. In order to keep the time in mind and to stay more or less in schedule, I would like to ask your questions shortly and probably directly to someone from the podium. Just raise your hand and you'll be given a microphone. I suggest we collect 3 questions and then you can answer them, and then if there are more, the other questions.
Franz Nauschnig, European Task Force Carbon Pricing. My question is related to energy and hard budget constraint. So we are investing half as much as China is investing in the green transition. So the Chinese are investing double. You said if we invested the same as in China, our energy prices would have come down. We would have much more renewables in the grid. Our problem is that we make energy more expensive because Verbund, you must first earn a lot of money that you can invest. Under hard budget constraints, you can use a much more efficient stuff. You can use what we had in Austria in the 90s when we had the same problem, hard budget constraint, lowering our deficit. We invested outside the budget. We had the so-called ASFINAG. We could do an ASFINAG also for the energy grid for the 10 billion you said. It's very simple. You give a state guarantee when you have cheap financing, much cheaper than Verbund. And for example, we could also increase as Europeans the capital of a European Investment Bank so that the European Investment Bank can invest much more. Simple.
Thank you very much. The second question.
Not really.
Over there, and then the gentleman in the back.
Yeah, thank you. My name is Kurt Bayer. I used to work for the Ministry of Finance. I was also the Austrian representative at the EIB board for a while. And I would like to ask a question to Mrs. Revoltella. Matteo Ferrazzi said that the fragmentation in Europe is one of the big problems. And my question is whether the country-by-country approach, which EIB does, isn't really actually furthering fragmentation, whether the EIB shouldn't do more European-wide projects and not country-by-country.
Thank you. Probably the last question, and then we'll start answer. The gentleman behind you was first, I'm sorry. Yes, we're listening.
Yeah, thank you very much. Thomas Lacik, Österreichische Nationalbank. I have a question for Mr. Kollmann. How do you assess the new Green Deal, so the Clean Industrial Deal presented by the Commission about a month ago, which aims to achieve competitiveness or increase competitiveness in the EU by making energy cheaper, especially by investing into grids and the interconnectedness of grids? You mentioned that you have to invest in grids yourselves, but is this really the way to go? And this is what is missing in Europe and what will make Europe cheaper. And another part of that of the deal is the long-term contracts, power purchase agreements. How do you assess those, and especially the role of the EIB? Which role should the EIB play? Do you think this is a market failure that we have been facing so far, and this is exactly what we need, where the EIB would support or provide guarantees in order to increase the share of long-term contracts, these power purchase agreements? Thank you.
Thank you very much. So let's start with the first question. Do we need an ASFINAG for the energy sector?
I would like to take a step back. When we own Austrian power grid 100%, and all the money that goes into the Austrian power grid to make our grid hopefully as efficient and as modern as possible in order to integrate the renewables and to make the energy transformation work, comes from us, comes from Verbund. So we are outside the budget. and we're not influenced by budgetary constraints. We are indirectly influenced because we have to make extra payments in addition to the 1.5 billion which we have already paid, for example, last year in terms of taxes and dividends. So that is in terms of the grid. You mentioned China. China in 24 in 1 year has built 227 gigawatts of solar in 1 year. That is more, in fact, that is twice as much as Germany, who is sort of like the Hercules of the energy transformation, has built since 2000. I repeat it. So in 1 year, they have basically built what all of Germany has built since they started to put their own PV in the year 2000 into place. So that gives you a feeling for how much they achieve. 80% of panels come from China. 83% of all the batteries come from China. The batteries which we get are not even the newest generation, because the newest generation they keep themselves. They are way ahead of everybody else in terms of, together with some other Asian nations, in terms of solid-state batteries, i.e. increasing the efficiency of batteries and the load factor of batteries. In terms of silicium wafers, they are at around 90%. And in terms of wind, their wind turbines are around 30 to 40% cheaper, and in terms of the same quality as the European ones. So those are just facts. Yeah? Those are just numbers and facts. As a result of that, for us to remain the energy transformation champion will be a huge challenge for Europe. We already, we talked about gas dependency for many, many years. We are totally dependent on China on many, many components for renewables. In terms of PPAs, power purchase agreements, long-term agreements, I think that is very valuable. Any support from the European Investment Bank in terms of developing that market would be more than welcome. Overall, I think that the reflection of the European Union to not only focus on the Green Deal, but to combine the Green Deal with the competitiveness makes a lot of sense. The challenge, and that has been a little bit like the theme of all the things I have said, the challenge is the implementation. I've been at a panel discussion not too long ago with a representative of the European Union, and he has basically gone through the new competitiveness combined with our green objectives. And to me, it sounded like a very, very long list of things we would love to do. We need, again, as I've said a few times today, we need to be very specific. We need to have very realistic goals. The best would be not to have 20-year goals, but do it like the Chinese. They have 1-year goals. They also have 10-year goals. But they have,
and 5-year plans.
And 5-year plans. But they break it down. They break it down to 1 year. And if they don't achieve it after 1 year, they basically say, why didn't we achieve it? And they adjust. Companies do exactly the same thing. So that is something we should do on the European level as well. I think that would be a great idea. Have I answered all your points? I'm not sure. I'm a huge fan of ASFINAG.
The second question was asked directly to you. Yeah. A country-by-country approach by the EIB and whether it is out or not.
My answer is I think what also we had in our report. We should have instrument European level. Then the EIB is acting at the national, supporting at the national level or with a European instrument. It's true there are both. I think we should do more and more European. That's clear, but it is still the very strong advantage of having the European instruments is that at the end they are deployed, they can be deployed everywhere in the European Union, while a national instrument can only be deployed at the national level. So there is an advantage in any case of having the European instrument administrated. But I agree with you that we should open more and more European level. And in practice, whatever we do can be replicated in every country.
Is this answering your question? Do you want to add something? Or?
No, I would say that's answered, but it's absolutely a good idea, and the EIB is doing as much as possible to finance projects at EU level, and also the demand from the states is coming, kicking on, so on the country level, but they are complemented.
And the third question was on the Green Deal investments in grids and the EIB's role. Who wants to answer this? Or who do you...
Sure, let's just start with one important thing. We need effective legal frameworks. I give you, because it's always good to have an example, because it's more tangible. We have been working on a relatively small section of the high network circle. It's called the Salzburg-Leitung. The Salzburg line is a high voltage line. We started thinking about this 17 years ago. I wasn't even at Verbund at the time. We started the entire process 13 years ago. Again, I wasn't at Verbund at the time. And we're going to complete it probably next year. The approval process has taken 13 years. In the meantime, the costs have gone up from around 500 million to more than 1 billion. So 600 million more because of a very lengthy approval process. So not just sort of like everybody should have the right to intervene in terms of biodiversity and all that. I mean, we are a very green company. We think that is very important. But decisions need to be made very quickly. So you don't wait for years, but you basically say, okay, there's an intervention, there is a bird that should be protected, or et cetera, et cetera. All that is important, but it needs to be decided quickly. Because of the framework being too wishy-washy, 500, 600 million more that is basically being paid by the customers. Yeah? And that is something we need to work on in terms of the energy transformation. So we need very effective regulations and legal frameworks. And this is something where probably Europe can help, because if Europe sets a framework and says to their member states, listen, the energy transformation is a European objective. This is very important to us in order to increase competitiveness. But in order to get it done, why don't we do ABC? And this is where I think the EIB could probably have an impact as well.
We've heard before that there are huge investments in energy. This is part of also the Green Deal, because reducing emission is one of the scopes, but also part of the competitiveness. When we speak about competitiveness, it's not the general productivity of the economy, but also the autonomy, the strategic autonomy of EU. So not to be dependent on oil and gas imports, and also to have cheaper energy, because we have also, let's say, a problem with the energy price, as we mentioned. So there are huge investments. We're mentioning 30 billion in the last years, where EIB, of course, is involved, being one of the EU priorities. So that's a big focus.
Thank you very much. Do we have some more questions? The gentleman in the second row. No? Anyone else? Over there in the back.
Fabio Rumler from OeNB. So I have a question to Mr. Ferrazzi from the EIB. So, I mean, I couldn't agree more to what you said, and I think every European thinking person wouldn't agree more to what needs to be done to achieve the goals. Right? Draghi summarized it in his nice report. We know this, we know the whole agenda for many years. It didn't happen so far. I'd like to ask you what you think could be done or should be done in order to get from the diagnosis to the action, given the strong political headwinds that we are facing and maybe increasingly will face in the future of European, political parties or countries drifting more to the right that are opposing this and are actually supporting the fragmentation. So in order to, in these circumstances, in this mood, what do you think needs to be done to get the agenda through against these headwinds? Thank you.
Thank you. And another question from the gentleman.
Thomas Mühl. A question to Mr. Kollmann. You were referring to the root cause of the high energy prices as the Russian attack on Ukraine and the higher price on the on gas. And you said that once there will be peace, also the energy prices will come down. In my opinion, this will only happen if these Russian gas quantities be back on the European market. Do you see that as a realistic scenario to happen, that once there's peace, that Europe will switch back to simply sourcing cheap Russian gas?
Well, then let's answer those two questions. First, Mr. Ferrazzi, from how do we get things done instead of pointing out what has to be done regarding the political disruptions we are also facing in Europe?
Thank you for the question, because it's mixing up the political aspect with the economic aspects, and that's very important. So I think we are well beyond the analysis phase. Also, the Draghi report is really setting some policy priorities. I think the next step is also to look at the barriers, why we are not doing certain things. One of the things, small suggestion, if the anti-EU parties are gaining traction, but on the other side they are never achieving more than 50%. So for the others is to keep the bar on the EU perspective, I think is very important. So just to do their job, they are voted for a certain kind of policy, and then should not follow any anti-EU sentiment just to try to gain in the short term a few votes. And this would for sure push very much on the EU agenda and let's say limit this fragmentation that we have seen multiple times. Then there is, let's say, to square the benefits for some countries that are sometimes feeling that they are, let's say, penalized by a common market or a common spirit. One example is the capital market union that would benefit everybody. Sometimes it was perceived as a matter for the financial sector, for bankers, but we have seen with the scale up, how the gap with San Francisco is there. This is a matter of financing the ideas of the people, especially young generations. They have ideas, and you have to get the money around Europe who believes in you, who will invest in your company. And if you are from one country, you should not be refrained from investing in idea from another European country. So I would say, again, is a matter of removing the barrier and trust the political project that is the long-term project, let's say. That's, I would say, and also the Trump administration should not scare too much if we keep going on this direction. Because if we look at the main directions, the main points, we have seen the green transition, sometimes on the other side of the Atlantic is not so popular anymore. But all the companies that were on this green transition, they were exporting with plus, say, 65%, plus 40%. It was very successful. The social model is very strong. The single market is very strong. So I would say there is a lot of room to go in this direction.
Thank you very much. And the last question was whether Russian gas will come back to Europe or no. It is finding its ways in form of LNG, but I get your point.
Yeah. Yeah, thank you for your question. This is actually very close to my heart, because in addition to finance, I'm also responsible for infrastructure, and we own 51% in Gas Connect Austria, which is a central European hub, mainly for Russian gas. and is a transportation network going through Austria, as we're in the center of Europe. Very important function for all of Europe. In terms of Russian gas, the pipeline running from Russia through the Ukraine into Austria is called Brotherhood. Until 8 weeks ago, well, 12 weeks ago, we were still receiving gas from Russia into Central Europe. At the same time, you're right, LNG is a company called Novatek. There is a lot of Russian LNG coming into Europe. Nobody talks about it, but Russian exports to Europe have increased dramatically. So a lot of Russian LNG, not pipeline gas, that has reduced dramatically, but LNG imports into Europe have gone up quite a lot. If we have a peace agreement between Russia and the Ukraine, and this is pure guesswork, but as we had throughout the entire 24 running Russian gas, through the pipeline, through the Brotherhood into Central Europe, I could well imagine that because the pipelines are running, they're fully functioning, the compressor stations, they're all fully functioning, so it's just sort of like switching it on and then the gas would flow again. That certainly would reduce the gas price. And when you look at the gas price today, the 1 year forward, so what is traded today for delivery in 1 year is already a lot different from where it is today. So the gas price today is above 40. The gas price for delivery in 1 year is around 30, 32 maybe. Yeah, so much, much lower. When you look at, and stop me if I'm getting too complicated, but the merit order is not, the pricing of the merit order is not as difficult as one thinks. So when you basically look at a gas-fired power station with an efficiency of 50%, you need 2 units of gas basically. So if the gas costs 30 euros per megawatt hour, you take 2, you're 60, then you need to pay for the CO2. At the moment it's 28, so you're at around 70, 80 euros per megawatt hour. But that is sort of like, that is the highest gas price. That is the highest power price. As a result of that, if we really get down to the 30 euros, or maybe even to 25 euros, the power price in Europe will come down for all of Europe. And then with the build-out of renewables, which hopefully, I mentioned the legal frameworks, which hopefully happen quicker and more effectively, then of course we should have a more competitive power price. And hopefully that will stop the deindustrialization of Europe. We haven't even talked about that, but that's an important subject that is not just happening within the last few years, but has been happening within the last 10 to 15 years. Hopefully we can turn that around.
Thank you. Do we have other questions from the audience?
Just one sentence.
Yes,
we could bring down the power price immediately if we adopted an Iberian model, the way Spain and Portugal did it, and subsidize the gas price, because then we can bring down the electricity prices much more for everybody, right? And I think it's a big mistake that we weren't able to do this for Central Europe and Austria.
Mm-hmm.
But
No.
he has to pay for it.
that's the consequence that we have the money that we don't have at the moment.
Yes, we have to buy the gas anyways, and we would subsidize Germany with lower energy prices.
Yeah, but the subsidy is much smaller than you would get a huge reduction in the power price for everybody with a very small subsidy compared to, right? Yeah. So that's the economic effect that you would
Okay. Last question, and then I will close the discussion.
Georg Brasseur, Technische Universität Graz. Wouldn't it make sense to invest into improving the efficiency of the fossil energy use, because we still will rely on fossil fuels for the next decades? And as fossil fuels are quite cheap, or had been quite cheap, it was not a very high stimulus to invest into processes that improve the efficiency. But this could be done even today. And this would also help in the future if these fossil fuels move to green fuels, then also due to high efficiency, the consumption will be lower. So if you invest today, and this means innovations, good ideas, into reducing the use of fossil fuels because the conversion becomes more efficient. In my view, this may make sense. And I think many of you have nice ideas how this could be done. Thank you.
Shall I comment on that quickly? I think you're right. You cannot ignore fossil fuels. We like to ignore it, but we can't. In Austria, 75%. In the world, between 77 and 80%. That will actually continue. When you look at sub-Saharan Africa, when you look at India, where people don't even have electricity to cook or to heat their homes or air conditioning, to that extent, there the use of fossil fuels will increase. It will not decrease, it will not stay the same, it will increase dramatically. So you're right, it is important to take a global perspective as well. We should include the oil industry. We should not pretend that this is bad and we don't want to talk to them. We should definitely include them into our discussions. And if we were able to increase the efficiency of fossil fuel utilization, that would actually have a direct impact on CO2 emissions. And that is something one should think about. And that just shows sort of like, I hope it came out a little bit of our discussion today, that we always need to take the 360-degree perspective. We need to look at every angle. We should not be too biased. We should always be open and transparent towards different ideas in order to achieve the goals which we have. So it's a very good point. Thank you.
Thank you very much for your questions. You are very welcome to continue the conversations on a bilateral, in a more informal settings with rolls and drinks outside. Thanks for listening, and on behalf of the panel, have a pleasant day and